Hi, I'm Mark Rosano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. So today we have our econ show. A lot of stuff to talk about, a lot of new data sets that have come out, and we want to go through what does it mean. Obviously, there's people are changing their narrative based on price action, but is price action really where the economic data is pointing us? And those are some I think important things that we really want to touch on and some of the drivers behind it. So we're going to break it into pieces. And there was a really good chart that showed, what are some of your number one fears going into this year? And the cost of living crisis was, I think, a big one. And that's where, so we want to talk about why are people worried about cost of living? How is that going to dictate things going forward? So we're going to talk about that, what's happening on the food front, how is that starting to come to pass. Then we want to look at the leading indicators in the U.S. and the data doesn't show a Fed pivot. Like yes, there's been some slowdown in year-over-year inflation, but core inflation still running heavy. You still have some pretty positive jobs data. That none of that shows. The Fed's going to pivot. Yeah, it's again we still believe that that is a long way away. And then we want to look at within that also where some of the leading indicators are in terms of that economic growth. And then we're going to follow that with small business data, which turned negative again. It's still right at the lows, one of the lowest it's ever been since its inception. And where is that in housing? How is that continuing on the real estate front? Then we want to look at Europe, where economic data continued to improve. We did get a nice little bounce, but wage growth got worse. And so again, you still need that consumer, and we want to kind of weigh, is the economic data getting better because we're bouncing off the lows, or is it something where last year was just that terrible, so this year looks better, but really not as good? And then in the final segment, we're going to look at China's reopening and why, again, that is completely, it's the market's giving it a lot of credit, even though there's, what are they reopening into? They're reopening into a global slowdown, a global recession. So yes, things will get better, but we really need to pare back. I think what is getting better? How is that going to continue? And then as we've been talking about Japan and India, we want to talk about Japan, what's happening there, and some of the issues that have continued to come about. So with that being said, this is the top global risks in 2023. And I know for myself, I would say that most of these things are right in line. And selfishly speaking, when we created our C6 private equity fund, we saw in 2019 an energy crisis. We saw an inflation crisis. We saw food supply problems, and everything that we've invested in is to address this. So I think it takes time for people to kind of come to terms with what is to come. And now that it's here, I think that these are real problems that are not going away anytime soon. And that's why when we talk about the 70s is a great period to compare us to, just because the energy supply crisis did not go away in a year. Like, even though obviously you had the embargo, then that the embargo was lifted, there were still ramifications and problems that came on the back end of it. And Russia-Ukraine is not ending anytime soon. There's a lot of issues that continue with the energy supply side, which impacts how much electricity do we have? How much power do we have? How much diesel do we have? Can we mine copper, aluminum, iron ore, things that we need for daily life? And if you don't have enough, well, that creates a cost of living problem. If you can't get things affordable, well, that means that your cost of living is going to go up. The things that you take for granted, which is why we talk so much about core inflation, sticky inflation, because these are things that are impacting those cost of living problems, which then is all driven by rising inflation. And rising inflation is a big piece of the food supply crisis. So the food supply issue, which we're going to talk about at the end of this segment, has not improved. There is still a problem. There's still shrinking in terms of the problems that we have. I mean, there's been more bird flu. creating the egg inflation. Though there's so many different pieces of it. And then as I think what most people can talk about, and when I was at Bloomberg, one of the big things that we did was IoT and looking at, cyber attacks on infrastructure, soft targets was a lot, very low hanging fruit. And I think you're starting to see that come to pass. But the one thing that I want to highlight is where people view climate change and the failure to set and meet national net zero targets. It's up there, but not where it should. It's moving further down. And I think that's a big component when you start weighing where people are looking at different things. And the one piece here that I think when you start to see some of these pivots, the debt crisis. We have talked aggressively about Japan, how the BOJ only had one option, which was to raise the ceiling, and that the market was going to push them to do it. And it came to pass, and it's continuing. There is a debt problem out there. It still exists in China that has not gone away. It continues in Japan, and now in the U.S. we have a big backdrop of things to come when you look at the new debt ceiling. What does the debt ceiling look at? Again, we'll raise the debt ceiling. I don't think that's the issue. It's just, what do we have to give up? And is it something that we're going to shut down the government again and not pay bills because we're going to use that as a tactic and tool? And these are some key risks that I think are important to look at because they're not going away. And all of these things impact people's lives to a very big degree. Cyber attack on critical infrastructure, we saw it with Colonial Pipeline. The debt crisis is something that I think you're going to continue to see that move up, and the disruption in global supply chain that will start to move down. So you're going to get some of these readjustments, but I think these 4 or 5 big ones are really not going away, and that's going to be a big problem going forward. So, the graphic summarizes the findings from the Global Risk Report, providing an overview of most pressing global risk world in the different areas. And just to summarize it, in the U.S., there's not going to be a soft landing. We're on track for a third straight quarter of declines in real retail sales, alongside 2 successive negative production numbers. And again, these are things that only happen in recessions. Not to say that we're going to go down 15%, because we've been saying from the beginning, the U.S. is going to be down, let's call it, 3%, 2 to 3%, but we're going to stay down. And a lot of these problems are going to be very sticky when we look at where things are going and how that's going to progress on not only just the global front, but also on the U.S. front. So as we weigh all of these risks, well, what does that mean? What happens to the world at large? And when you look at ISM manufacturing PMI, you get an idea that as that goes negative, as you see that getting pulled down, U.S. consumption of petroleum products obviously come down with it. But one of the things that we've been saying at Primary Vision, in terms of our insights, in terms of the things that we've written extensively on, is that we're going to see petroleum product demand come down. Consumption's going to fall, but we do have a supply problem. So it's the back and forth between where is demand, where is supply on crude products. But one of the things which is why we're building the NGL model, why we've been so adamant about natural gas liquids, is that the rising consumption of petrochemicals is going to offset that drop in gasoline, that drop in diesel. So when you look at what OPEC puts out, which is, the demand side, and when they're just using 100 million to make it easier, when they say that there's demand of 100 million barrels a day, that is not all crude. There's a big part of that is natural gas liquids, naphtha, liquids in general. But those consumptions are going up. So that's where you're getting this balancing act. So when we talk about it, it's like, look, oil demand's going to fall as it does during recessions, but there's that offset. And the benefit for the US, the benefit for our production, is we make a lot of liquids. And that's where you have this back and forth in terms of, well, what is real demand? Because people look at that 100 million barrels a day and say, oh, we're going to 102, 105. Oil demand isn't going away, which is true. Oil demand is not going away. We're not even, are we plateauing? Maybe. We could go back and forth on that, but the growth is really going to be driven based on where we are on the NGL side, which we think we're very bullish on, and we do think NGL consumption is going to continue to rise. Now, when we look at global supply chains, they're going to become more diversified. Those are things that we've talked about and we called for and told people to do with our clients back in 2019, well before 2020 happened, just because we see things happening, we see things coming. There was always that there wasn't the buffer that was needed. So as you look at it, lost sales due to customer uncertainty of continued supply chains, those are things that they want to address. If you don't have inventory and if someone goes to buy your product and the product isn't on the shelves, well, you missed a sale. So there is a certain amount of, if you want to go that route and say, well, it's exclusive, or that's a missed sale. That's an economic loss. Shifts in suppliers, all of those are shifting, delays and cancellations. So as you look at the diversification, as we've talked about over these past year and a half, companies are looking to diversify outside of China. Not to say that they're going to shut all activity in China, because they're not. It's just shutting one or two facilities and moving them into Vietnam, into Mexico, into India, and into other places that are closer to their end users, and starting to streamline. And that's why we get that nearshoring and onshoring. It'll be more diversified, more resilient, but it's also going to cost more. And the costs are rising because from the 60s and 70s into the mid 80s, we were exporting inflation and importing deflation as we moved manufacturing abroad. Now, as it starts to circle back, that's when you start to see a bit of that inflation and gets us to that stagflationary backdrop. And one of the things I think this was a great by Nordia putting it together, NAHB, slight bounce, but already in deep recession territory. IP and retail sales gradually aligning to the recession story. Their U.S. GDP model still shows the recession and has since going back to 1970 based on the way they model it. And the Euro model also shows that. And I think it's important because you're seeing some bounce in some of the data and you're seeing a lot more weakness. And we'll talk about Empire State data getting worse. But there's this move in price action. In January, people get bullish, they deploy capital. That's when we want to come in and say, look, there is a underlying thesis here where price action will do one thing, but the economic drivers continue to be stuck in neutral and moving into reverse. And now Europe already did that. So is Europe bouncing? Sure, it's bouncing off of very weak numbers. So we have to really weigh what that is. But where are wages? Where is spending? And those are going to be the key drivers of where things are going and how this recession is going to unfold. Now, as you can also see, China has finally announced what I think many have already known, and the view was that this actually started in 2020, was that they now had negative population growth. So and this gives you a breakdown between China and India. Now, the problem with China is, yes, they're obviously starting from a very high number, but based on their one-child policy that was carried out until really the early the early 2000s, and started to waver, you had a lot of men being born, not as many women. You have now this underlying expense for raising a child, which is why you still haven't seen, even as they lifted the one-child policy, it's still very expensive, which is why they went after tutors, because there was a shadow benefit for within China. So, and if you wanted your kid to get to the best schools, you had to pay the tutors. The tutors had the right connections. You paid the tutors to pay the people at the agencies to get them into the best schools. So there was a lot of money, and that created a crackdown on tutoring and all these other pieces because they wanted to make it more affordable. But you still have a negative decline rate, and there isn't an easy way to change that given the lack of women in the region, the very limited, if any, immigration. So you're seeing these problems. So On Tuesday, they revealed that the population fell by roughly 850,000 people last year to 1.412 billion. And you might think like, all right, 1.4 billion, 850,000, like that's a rounding error. And that's why, they talked about this is the first decline in over 6 decades. And it's important because it's more than 850,000. The fact that they're admitting it means that, as we talked about in 2020, you just had to use their math and you could see that there was a problem. You saw this dropping, and now it's so egregious that they had to come out and say, look, this is where it is. It's still a rounding error to them, but realistically, it is much greater. Now, are we talking about 10 million people? Absolutely not. But it is something that can be measured in the millions. And when you look at it, top advisors say the population started shrinking much earlier than expected due to the low birth rate. We've had to keep bringing forward our estimates of the peak each year, and that's where you continue. The birth rate fell to just 6.77 births per 1,000 people in 2022, the lowest figure since records began in 1949, and then the death rate rose slightly. But the thing is, this isn't a one-off, and when you look at 2023's birth rate, you'll see this as people keep putting it off because zero COVID. You're seeing this traction continue, and the death rate's going to come up. So we do see this as China continues to age, as they continue to see these problems, and this is going to become a bigger issue for, there's a lot of ghost cities already in China. There's a lot of underutilized components. So when now, you're going to have falling production, falling, workers, and how are you going to pay for pensions and tax rates, and all of these things have a compounding effect, which we think is going to become a bigger problem. Now, from the perspective of the rest of the world, China has been in a recession because their import volumes have been negative. And as China doesn't import as much, well, China imports a lot from emerging markets. So that's why when you look at the emerging markets, and we'll talk about the trade data as we go into segment 5, you're seeing a lot of this continue, which is why we think there's more reverberating impacts. And as we said, as China reopens, they're reopening into a recession. So as things may get more normal internally, it doesn't mean that their exports are going to grow exponentially, because when they were reopening in 2020, they were reopening in 2020 into a massively short market. Inventories were short. Everybody was panicked. All of this ordering was happening. You don't have that now. There is no bump like we had in 2020 and even parts of 2021. So those benefits have now been alleviated, and they're reopening into a bigger slowdown. Global leading standard and policy rates, global GDP weighted policy and lending standards continue to go up. So that's if you, from their top down, the double trouble, funding conditions have tightened on both ends. Banks are becoming more stringent and stingy in their lending decisions, and the interest rates on those loans are now a lot higher. And again, as rates continue to go up, central banks raising rates will continue to put that pressure. So if it's a situation of, even if you can get a loan, you may not be able to afford it, which we've seen, which is why when you look at some of the leading indicators, it gets worse over the 4 to 6 months and the 8 to 12 months. But there is a view that there's this nice bounce in 12 months time, but you're still negative. So you're bouncing 12 months from now, which again would put you into January of 2024, but you're still in a recession. You're still showing negative growth, which is something that we think is going to prolong and be a problem as we continue into the end of this year. Global Recession 2023, one of the most interesting pieces of work that was to perform a sort of the analysis on those leading indicators. And here's where you see, again, that's a quote from top-down charts. OECD data, as you can see, again, bouncing, but still deeply in a recession territory. And you can see it's still even at the lows that we saw in 2008. And the question is, does the bounce continue? And we can confidently say no, not based on the data we have seen, the leading indicators, especially when you look at some of the local Fed data. And again, that's going to keep OECD not buying. As OECD doesn't buy, as OECD nations don't buy, well, emerging market reserve operations are going to get even tighter because their reserves are going to dwindle, and because they're going to have to pull down from what's in their central banks. keeping them beholden to buying dollars at a fairly steady clip to try to offset, which is why Saudi has talked about offering up the ability to trade crude in non-US dollars, which again, to say it and to do it and achieve it are two very different things. Emerging market inflation is slowing down. So you've had rates running up, you've had activity slowing. So inflation should come down. It's still positive, but moving further negative, which is a positive when you think about a pause in some of their rate rising. But just because rates are no longer going up doesn't mean you're going to you're going to have a speed up or an increase of activity in the local economies. And then the market is extremely long US dollar cash. And that is something that, based on the shortages on that FX reserves, we don't see that not being the case because they need dollars to help insulate from inflation. That, one of these, these are connected, which is why they're together. Inflation coming down, expectations coming down as your dollar holdings are going up. But now your dollar holdings are dwindling again on the back end of that because your trade is slowing and you have to support the exchange rates, which is where we continue to see these problems and why we believe the dollar is going to remain elevated. Credit impulse versus global sentiment. One of the things that we've been saying is that global credit impulses were going to flatline, and here's where we think they bounce and then they start to flatline around here, still in contraction, and you're seeing the sentiment follow suit. And then when you look at global dollar liquidity, we still see rates going up. We still see QT is barely even started, which is why we think that the dollar liquidity is still going to remain negative to pull all of this excess out. And then the business cycle indicator within China, we think it's something closer to what we had from 17 straight through 19, where you're going to bounce, but again, just because you're reopening, but it doesn't mean that you're going to go positive. And that's where we see a lot of concerns and problems with China's expansion. Rising rates is also going to, again, pull down housing. And when you start looking at housing, that is a big driver of how people react in terms of spending. How do they feel wealthy, not wealthy? And this is going to become a bigger problem. And this gives you an idea of, yes, the U.S. is in a tough spot, but we are by no means the worst. So when you start looking at other developed nations, other OECD nations, you get an idea of why we think there's going to be a bigger slowdown that's going to persist, because there is a lot of froth to come out of this market, which is only just starting. And not to say that the central banks of these local regions have to continue to ratchet rates, but it also means that if they stand still, you're going to still see this pressure as financing terms remain prohibitive. And that's why when you look at the data sets, disappointing global trade data flashing more warnings. And again, that this leads back to global trade. Some of the trucking data within the US has been a bit better, but when you go back through the flows where things are, you can see that the world data continues to get a bit worse, especially when you use two leading indicators, which have always been Taiwan and Korea. And that's something where we think things are going to continue to pull and contract, as we've been saying on the global trade side. Now, UN data, when you look at food, you can see that the World Food Price Index fell throughout 2022 and ended the year at the lowest since September 2021. And the 6 months change still deeply negative and hovering at the lowest since the Great Financial Crisis. But it's important because even at the 6-month average being so deeply negative, we're still at the highest levels we've been at, and actually still above where we were during the wheat wars of 2000 and the Arab uprising of 2011. So if you think about this as becoming more of the new normal, that is a concern and going to pull that discretionary capital away from people because it's still going into the food. So this is by no means a chart to get excited about. And one of the things, for those that have been following us, our view was a spike, a little bit of a fade, and then a flat line. And that's how this is setting up, is more of this stable, elevated price level, which we really don't see changing. And when you start looking at the U.S. and other countries in terms of acreage, here you can see what's been harvested. U.S. corn area harvested coming way down, coming back to levels not seen since 2008. And this is, again, showing some of the cracks that we've talked about in terms of yield. We've had a lot of drought. We've had a lot of issues impacting underlying volumes, winter wheat acres. And here you can see what's been planted, but then what's been harvested. And that's when you look at this stagnation in terms of where the yields are. And this is what we've been talking about, where a lot of key growing areas are not seeing the yield they have in the past when you start looking at those harvests. And you can see here the bumper crops continue to get less and less. Even we had a little bit of a bump and then a fade. We're still well off of where we should be, given where we are, what the market demands, and how we're seeing. We've already seen storage and silos get dwindled down. These type of numbers are not going to fill them back up. U.S. production, here you can see corn harvested areas, obviously outside of the estimates. Corn yield was in range, but as you can see, right around the upper range, but corn production was lower. It fell outside the range. And when you start looking at this math, you start to see why we had a fairly sizable bounce in grain pricing. Soybean harvest area, this is obviously WASDE data, was in range. Soybean yield was lower. Soybean production was lower. U.S. ending stocks, they're in the range, but they're much closer to the low end than the higher end, which is more of the concern in terms of, we are not crushing through and having these massive bumper crops. We're at the lower end of estimates, which when you compare it to December, they're disappointing. Like when you look at USDA December data and USDA January 12th data, it's moving in the wrong direction as a whole, which is going to put essentially a floor in a lot of that pricing and start to send things higher. U.S. grain stocks, again, very much on the low end. And if it's not within the range on the low side, it's breaking to the downside. And then when you look at U.S. winter wheat, things are moving a bit higher. And so you're starting to get a little bit of a benefit in terms of where things are, especially as we've gotten some rainfall. The question is going to be, are we going to fall back into the issues that we've had? And it's important to appreciate that even though we're higher than estimates, these are still some of the lowest estimates we've ever had. So again, you're beating estimates that are already set at record lows. So you also have to put into context, yes, it's better than expected, but expectations were already really terrible. So now when you look at world ending stocks, you can see that we're within the range, fairly stable on the corn side, soybean same, and then wheat coming in on the lower end of where things were expected. And then when you look at Argentina and Brazil, Argentina is getting a little bit weaker, Brazil getting a little bit stronger. So again, you're starting to see some of that balance out. And then when you look at Russia, so wheat futures, there's been comments in terms of export controls where Putin has said we can't allow everything to be taken abroad. Now, there's an estimate that Russia has a 13-year high of wheat storage, but the question is, how do you get into market, and does it go bad sitting in storage? Or can they sell it into the open market? And that's where we continue to see a lot of these problems. And the short answer is no. It's going to be great for people within Russia because they'll be able to get fairly cheap, a bit cheaper product. But again, you're not pulling in dollars. You're not getting into global trade, and that's going to have ramifications for GDP over, above and beyond what we've already seen. And we're going to talk about how you'll be surprised to know that the Russian cap isn't working, or not working as well as expected. Which, again, I mean. How many times have you heard us say it? But it is what it is. Now, in the next segment, we're going to go deeper into the U.S. and things that are happening on the U.S. front.